Silver didn't just spike, it split in two. Right now, this week, physical silver in China is trading near $128 per ounce. US futures hovering around $111. That's not a premium, that's a fracture. And yesterday, nearly 1 million ounces walked out of Comex warehouses in a single day. If you're stacking silver, trading metals, or assuming futures prices still reflect actual supply, this matters to you right now. If you're watching this early, you're ahead of most institutional desks. They're still reading yesterday's close. We're watching metal disappear in real time. This isn't about predicting the top. It's about recognizing a pattern you'll see again in silver, copper, lithium, even food commodities. Your job isn't to know where price goes. It's to understand what these signals mean before they become headlines. Here's what's actually happening. Quick thing, hit subscribe if you're not already. We don't chase headlines here. We track the signals that move before price does, and we do it together. Because right now, while most commentary is screaming about rallies, something quieter is screaming louder. The facts are clean. Spot silver trading above $111 in Western markets. Shanghai physical pricing pushing near 128. That's a $17 premium, not slowly widening, but snapping open. And Comex registered inventories down nearly 1 million ounces in one day. Not rotating, leaving. Here's why that matters. Premiums don't widen in healthy markets. When physical buyers, industrial users, refiners, sovereign accumulators, when they stop accepting paper pricing, premiums detach first. Prices follow later, sometimes weeks later, sometimes violently. This isn't speculation demand. This is delivery demand. Someone needs metal now, not a futures contract settling next quarter. And here's the hidden layer most people miss. The futures market is still pricing like supply exists. Physical markets are pricing like it doesn't. One of them is wrong. And the longer that gap stays open, the more stress builds in the pipes no one's watching. Think about that. We're about 400 words in. Let me show you the mechanism that repeats every single cycle. I call it the physical override. It has a simple name because it's a simple pattern. Futures markets are traffic maps. They show where people think congestion will be. Physical demand is the actual road closure. And when the road's blocked, the map doesn't matter anymore. Here's how it works. Paper markets, futures, options, ETFs, they trade claims on metal. Not metal itself. Most of the time, that's fine. Price discovery happens, hedgers hedge, speculators speculate, system hums along. But when physical buyers need guaranteed delivery, not price exposure, actual metal in hand, they stop negotiating price and start negotiating availability. They'll pay $5 over, then $10, then 15s because the alternative isn't saving money. It's not getting metal at all. And here's the trap. Futures can stay calm during this, for weeks, because most contracts never deliver. They roll, settle cash, or offset. The pricing mechanism doesn't care about one buyer in Shanghai locking down tons of physical. It cares about aggregate paper flow, until it can't deliver. That's when the override happens. Physical demand forces paper pricing to acknowledge reality. And it doesn't happen smoothly. Right now, China isn't speculating on silver prices. They're locking in supply. Industrial users, electronics manufacturers, solar panel producers. They need physical metal, and they're willing to pay a premium that says, I'm not waiting for your futures curve to catch up. This is the part most traders never see. Because if you're watching screens, you see futures at $111 and think the market's pricing in modest optimism. You don't see Shanghai paying $128. You don't see metal leaving warehouses. You don't see the buyers who stopped bidding on contracts and started bidding on delivery slots. Why does this pattern repeat? Because every cycle, paper pricing assumes future abundance. It discounts present scarcity, because more supply is coming, or demand will normalize, or inventories are adequate. And every squeeze starts when that assumption breaks. Quietly, in premiums, in warehouse movements, in lease rates ticking up while everyone's focused on spot prices. Not telling you to buy or sell anything, showing you what to watch, because this pattern has played in palladium, cobalt, even lumber during supply shocks. The specifics change, the mechanism doesn't. Your job is recognizing the structure, not predicting the timing. We're at about 700 words. Let me add the compounding layer. Here's what makes this dangerous. Inventories don't decline linearly. They bleed, then they gap. Look at Comex silver. Total registered inventory, that's metal available for delivery, has been drifting lower for months, slowly. A few 100,000 ounces here, 1 million there. Market barely notices. Then yesterday, nearly 1 million ounces out in one day. That's not business as usual. That's clustering. And clustering is how confidence breaks. Imagine you're a bullion bank with short positions you need to deliver against next month. You're watching registered inventories. They've been stable enough. 1.1 million ounces, then 1.0, then 0.9, whatever. Still plenty. Then one day you see 30% of what's left just walk out the door. Now you have a decision. Do you stay calm, assume more supply arrives, or do you start securing physical now, even if it costs you. Most wait until they don't. And when multiple banks make that second decision simultaneously, withdrawals accelerate. Here's the spiral. Withdrawals pick up, remaining inventory looks smaller, delivery risk reprices, more shorts scramble to source metal, confidence erodes further, lease rates spike, physical premiums widen, new supply hesitates because what if this keeps going and the cycle compounds? We've seen this in palladium 2020, nickel 2022, rhodium multiple times. The mechanics repeat because the game theory repeats. No one wants to be the last short trying to deliver when the warehouse is empty. And here's the thing, right now, this is still early. Futures haven't panicked. Most analysis is still calling this a rally, not a structural shift. That's your edge. If you're watching premiums and inventories and warehouse movements, you're seeing stress before it becomes crisis. Circle this. If this continues, if withdrawals stay clustered, if Shanghai premiums stay elevated, if lease rates start climbing, then paper pricing becomes optional. Physical buyers set the price. Paper traders play catch-up or get squeezed. Could it reverse? Absolutely. New supply could flood in. Chinese demand could pause. Premiums could normalize tomorrow. Not making a prediction, showing a pattern. But if it doesn't reverse, we're at about 1-200 words. Here's what you need to sit with. This isn't about how high silver can go. It's about who gets metal at all. Because right now there are three groups in this market. Physical holders who already own metal. They're watching premiums expand and wondering if this is the cycle where paper decouples for real. Industrial users who need silver to build products. They can't wait for futures to sort themselves out. They need tons delivered next quarter or production lines stop. And paper traders, institutional desks, hedge funds, ETF market makers who are short claims on metal they don't have and assumed they could source later. One of those groups is about to have a very different month than the other two. And here's the tension. The futures market hasn't acknowledged the stress yet. Open interest is high. Liquidity looks fine on screens. If you're just watching price action, this looks like a normal rally. But if you're watching flows, if you're watching where metal is actually moving, who's paying premiums, what's leaving warehouses, you're seeing something that doesn't match the calm on the surface. Can't tell you what happens next. Could stabilize, could accelerate, could take weeks to resolve or months. But I can tell you this. When physical and paper prices split like this, and when one side is paying 15% plus premiums while the other pretends everything's normal, someone's pricing is about to get corrected. Let me show you what to watch. Not predicting, just showing scenarios and what signals them. First path is normalization. Shanghai premiums stabilize or compress. Comex inventories slow their decline. Maybe some supply arrives. Maybe Chinese buyers got what they needed and step back. Physical and paper converge. Watch for premium compression, inventory withdrawals slowing to normal levels, lease rates staying flat. Second path is sustained stress. Premiums stay elevated. Withdrawals continue clustering. More buyers realize they need physical now, not later. Paper market keeps trading, but physical buyers increasingly ignore it. Watch for premiums holding above $10 to $15, weekly withdrawal totals staying high, backwardation flickering in near-term contracts. Third path is a break. Delivery risk forces repricing. Either futures gap up violently to meet physical, or paper market loses credibility and physical market sets price independently. Shorts scramble, refiners get flooded with delivery requests they can't fill, watch for lease rates spiking, EFP spreads blowing out, multiple counterparties citing force majeure or delivery delays. No guarantees on which path we take. Could shift between them. Your job is tracking signals, not making certainties. Here's the watch list. What's normal, what's stress, how to read it. First is Shanghai premium versus Comex spot. Normal is $2 to $5 premium. Covers transport, insurance, normal friction. Stress is $10 to $15 plus. Says physical buyers bidding aggressively. Current is near $17. What it means is physical urgency outweighing price sensitivity. If this holds above $10 for weeks, not days, attention shifts from rally to shortage. Second is daily Comex inventory withdrawals. Normal is 200K to 500K ounces. Weekly, scattered. Stress is 800K to 1 million plus ounces in single days, clustering. Current is nearly 1 million ounces yesterday. What it means is delivery demand accelerating. Watch for patterns, same entities withdrawing, consecutive large days, registered inventory dropping toward critical thresholds. Under 30 million ounces, total gets attention. Third is lease rates and EFP spreads. Normal is near zero or slightly negative. Metal's easy to borrow. Stress is positive and rising. Borrowing costs increasing. Current is starting to tick up in some tenors. What it means is shorts having to pay to roll positions or secure physical. If this spikes above 1 to 2%, it's a flashing light that paper market is struggling to source metal. Fourth is Chinese import-export signals. Normal is steady flow, predictable seasonal patterns. Stress is import surges, export restrictions, bottlenecks at refineries or ports. Current is import data showing acceleration. What it means is sovereign or industrial accumulation. If China's pulling metal in faster than usual while premiums stay high, they're not speculating, they're hoarding. Fifth is backwardation flickers. Normal is futures curve and contango, later months cost more. Stress is near-term contracts trading at or above later months. Current is occasional flickers, not sustained yet. What it means is market pricing immediate scarcity over future abundance. Short-term stress tells truth first. If backwardation holds across multiple months, physical shortage isn't theoretical anymore. If you're a trader, respect volatility here. Premiums this wide can snap back fast if supply arrives or demand pauses. Position sizing matters more than being right. If you're a holder, accept that drawdowns can happen even during structural stress. Physical holders have time. Paper traders don't. Know which one you are. If you're watching from the outside, this is education. These signals repeat. Silver today, copper tomorrow, lithium next year. Learn the pattern. Not advice, just frameworks. Hedges for paper exposure might be rolling to longer-dated contracts, reducing size, securing actual delivery slots. Hedges for liquidity freezes might be diversifying counterparties, watching for dealer stress. Hedges for policy responses might be export restrictions, strategic reserve releases, price controls. Hedges for mispricing, if futures lag physical by weeks, arbitrage breaks, or someone gets squeezed. Your approach depends on your position and timeline. Can't know for you. Can only show structure. We're at about 900 words. Let's close this. Look, if you're watching premiums, inventories, and flow patterns instead of just price, you're in the group that sees stress early, not the group that reads about it in headlines after the move is done, not the group that buys at tops or panics at bottoms, the group that tracks signals and makes decisions with structure instead of emotion. That's rare. Most people watch price and react. We watch what moves before price does. And right now, what's moving is metal, physically, out of warehouses, across borders, into hands that aren't letting go. Could this reverse tomorrow? Sure. New supply, demand shift, premiums normalize. That's always possible. But if it doesn't, if premiums stay elevated, if inventories keep draining, if backwardation starts holding, then this wasn't a rally. It was the moment physical markets stopped pretending paper pricing mattered. And you'll have seen it coming. Not because you predicted it, because you watched the signals everyone else ignored. Your turn. Drop a comment. Are you tracking physical markets or paper markets right now? What signal made you pay attention this week? And if you've seen this pattern play out in other commodities, palladium, nickel, cobalt, whatever, share what you noticed. We learn from each other's pattern recognition. Hit subscribe if you're not already. Next video, we're breaking down what happens when delivery months tighten and shorts have nowhere to roll. It's already setting up. Final thought. Price is the echo. Supply stress is the sound. If you're listening for echoes, you're already late. If you're listening for the sound, you're exactly where you need to be. Links in description. See you next time.